Got 2 minutes until we close out the trading week. We've got full team coverage here for you. We want to bring in Jeff Klingelhofer. He's Thornburg's co-head of investments. We also have Kevin Riley, managing partner at Exponential Investment Partners. But first, let's get to our markets reporter, Ines Ferre, because Ines, we're looking at some buying action here into the close. The Dow now up just over 400 points.
Yeah, that's right. The Dow up about 0.8%, and the Nasdaq up about more than 0.5%. The S&P 500, the biggest gainer out of the major averages, up more than 1%. If we just take a look at a 5-day chart, the S&P is set to gain more than 1% over the last week. The Nasdaq set to close in negative territory for the week, and the Dow up more than 1% for the week. Taking a look at the sector action and where we're ending the session out today, we're seeing that materials and technology are gaining, communication services are under pressure, are underperforming. And over the last 5 days, you can see that consumer staples, real estate, technology have outperformed for the week, with communication services down for the week. And over on the NASDAQ, we can see that some of the players over the last 5 days, Tesla down 5% for the week. Tesla today down more than 3%. Some of the big cap names, not too many changes for the big caps over the day, but over the last 5 days, you can see Facebook down more than 2% for the week. Here's the closing bell for Friday.
Okay, we got a closing bell. Do the gavel, buddy. There you go. And here's where we're going to settle in the markets. The Dow's going to be up more than 1%, up 400 points. The S&P 500 is going to close up 65 points. The Nasdaq's going to be up about 1.25%, 160 points. As Inez was just saying, a lot of people smiling and putting that in the banker. As they say in Philadelphia, it's worth $50. Okay, the Trading Places reference. Sector action, as Inez was telling us, consumer staples up 1.6%. Energy was up almost 2.5% today. Information technology up almost 2.35%, as well as materials 2.5%, and real estate up almost 2.5%. Let's go back to the guests. I'm going to start with you, Kevin, because there's been this whole discussion about inflation and everyone getting all worked up. And the fact is, even at a yield of almost 1.7%, we're still basically in line with inflation. And this is all historically, in our lifetimes, other than the Great Recession, the lowest it's ever been. Why are people getting so upset by the yields possibly going up a bit more?
Well, thanks for having us on today. And yeah, we couldn't agree with that concept more. I mean, we're looking at historically low levels of inflation right here. A 1.65% 10-year yield, it's just not competition for stocks. You know, the S&P pays 1.7%. It's historically low, like you say. Inflation is at 2%. And, if you're buying bonds right now, you've got serious interest rate risk. Rates will likely continue to creep up. It's had quite a run recently, but we think this provides a real opportunity to pick up some high quality tech names, because obviously they've been driven down quite a bit. All of the FANG stocks, lots of the high flyers are down 30-40%. There's some real opportunities there, we think.
Hey, Jeff, how are you looking at this? Because those inflation numbers we got out really certainly shows that maybe some of this fear could be overdone. Is that your view right now?
It is our view. Right now, I think all eyes are on the Fed, right? And we have to keep in mind, coming out of the global financial crisis, we were at zero for 7 years. So the markets today expect the Fed to lift off sometime 22 or 23. But at least looking backwards, that would be preemptive. And on top of that, the Fed has switched their mandate. Coming out of Jackson Hole last summer, they have a different look to them, right? They'll be looking backward rather than looking forward. And that's a huge step change. We're going to have to see actual inflation before the Fed moves. So I think that the story is here. We're a little bit preemptive as markets. We've got a long way to go in the labor market, and wages will have to rise before we see a sustained rise in inflation, which we just don't see in the coming year or two at least.
Hey, Jeff, I want to continue on that, because you say people should temper their expectations for a post-COVID world, but they could also get burned if they're moving into bonds. Can you help some of the people watching avoid getting, burned by that?
Absolutely. So the challenge, of course, is that there's risks on both sides. And the risks are, what if things are different this time? We're talking about a $4 to $5 trillion stimulus. The risk is out there. I think it's incredibly important. And what we are advising our clients at Thornburg is to remember what fixed income serves in a portfolio, right? If equities do well, that's great. But fixed income, at least in the core sense, is really meant to be ballast to a portfolio. So what you want to do is try to avoid significant interest rate duration, try and find the sweet spot where it can offset potential challenges in the market. But by and large, you should be playing defense today, not offense within fixed income. That's what we're doing in our portfolios. And that's what has led to tremendous success over the previous decade.
Hey, Kevin, we've seen some of those overheated groups. I'm talking about tech, at least. We have the NASDAQ in the red for the week. We have the Russell 2000 off just around 3% for the week. As we see a bit of a pullback in some of these sectors and some of these names, is that a good thing for the market?
Well, we think it is for a lot of the FANG names, as I mentioned. And then also, we've got earnings coming up for all of these companies. End of April, we've got Amazon and Facebook and Apple earnings coming up. We think they're all going to have really strong quarters. So we think there's opportunity there. They've come down 10, 15%. And then, the high flyers like the Zooms of the world, we feel at Exponential that they've completely changed the way business is done in the world. And so we think, that company being off, 40% or whatever it is at any given time this week, we think that's some real opportunity right there to try and pick that thing up. We think technology is the way to go going forward. We think that's where investors will make most of their money in the medium and long term. And we think that's a good buy at this stage.
But when you talk to your investors about technology, Kevin, do you point out the fact that these major names, because there's been this rotation, everyone talking about going from big tech into the more small cap or even cyclical stocks, value stocks, these men and women don't have debt. I mean, these are huge companies that don't carry a debt burden.
Yeah, exactly. So all this fear over, rising interest rates is kind of a moot point for them because they don't have any debt. So there's nothing to consider there. So we think that's overblown. Also, you've got the whole theorem of, discounted cash flows, future money being worth less because interest rates are rising. Well, these companies, all these FANG names are immensely profitable right now. So that discounted cash flow theory, we don't think really applies as much to them either.
Jeff, with all this taken into consideration here, we talked about inflation, we talked about the Fed, we're also closely watching the reopening trade right now. What matters most to the market?
I think you nailed it right at the end. It's the reopening. It's about getting shots in arms. It's about having the consumer return to a true sense of normal. I think Kevin mentioned it really well. The big question right now, there's one of them is rates, but the other side of that is growth, right? And I think watching consumer sentiment, watching the jobs reports, watching as we return and the pace that we get back, I think will be really the key. The only one other thing that I would point out, of course, that we saw this week with the Biden press conference was, what does the normalized world with China look like? Coming off of Trump, we all knew what it looked like, but focusing forward, there can continue to be some ups and downs there and some potential volatility. So watching that incredibly closely, I think will be key to the market over the next month or 2 months as we open up.
Jeff Klingelhofer, Kevin Riley, thanks so much for hopping on here and joining us today.